Log on to patreon.com/Dane Calloway or paypal.me/Dane Calloway to support me, my channel, and my content.
Any amount is very much appreciated, and I humbly thank you.
Millions of Americans are aware of a variety of explanations surrounding this topic at hand, due to the popularity of utilitarian credit and debit cards, consumer-to-business transactions, and many other correlating factors alike. In some instances, Americans are either uninformed or misinformed about the terms credit and debit, which merely leads to more confusing complexities for the individual. First, in a personal sense, not referring to the cards you utilize, but the terms credit and debit means the exact same thing in today's society. Now, many people may not have heard that before because of how each transaction works, but if you look closely into their meanings, duties, and responsibilities individually, you'll be singing a different tune. Contrary to most popular beliefs, both credit and debit were established within the same accounting system, also known as double entry bookkeeping system, acting as two separate columns but delivering the same exact results for an individual overall. What's important to note, the term credit originally derives from the Latin word credere, meaning trust or interest in English, while the term debit derived from debere in Latin, meaning should or owe in English. To put things into a narrowed down perspective using each definition, having cash in your hand is an asset, or rather a credit. Why? Because you can trust that it's in your hand at that time. Now, should you go to deposit that same cash into your bank account, that is considered a debit. Why? Simply because that money is owed to you because you lent it to a bank. So, when you want to use some of the money available to you inside of the bank account's balance, your money will be credited to you once it is debited from you, or rather the money will be debited to you once it is credited from you. In other words, the process works both ways. One can be an addition at some point, while the other acts as a subtraction. And then, in most commonly known cases, they both will switch roles and do the total opposite of each other. It was just a play on words and a little social engineering to make the public believe that they are actually two separate entities, when credit and debit does in fact serve the exact same purpose and meaning in today's society, and that is a debt. Before this methodology format of accounting was adopted by rulers in the West between the 13th and 15th centuries, an ancient form of accounting was recorded between the 11th and 12th centuries, surrounding a rather large mass of land in East Gondwana, covering parts of South Asia, more commonly known today as India, the Middle East, and Northern Africa. According to many historical records, the ancient Indian, North African, and Middle East Muslim civilization had written accounting, reporting, and auditing systems for the regulation of zakat, allegedly beginning in the year of 976. Records shows receipts recorded on the right-hand page and payments on the left-hand page, with conditions to exclude later tampering. More about this in a later documentary, of course, but this part is very essential to note concerning the establishment of the entries later called credit and debit by the French, English, and Spaniards of the West, adopting this ancient, quote, double entry bookkeeping system during the 15th century and claiming that they invented it themselves during the 18th century. The double entry bookkeeping system is still the standardized method used worldwide to store financial information of any entity, business and non-business, using, quote, accounts in which each financial transaction has two effects, credit and debit, hence the term double entry. Now, there's a flip side to this that one must totally understand. What I'm about to share next is very critical concerning us as human beings. 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 Over a period of time, this system is still in play, but many of its rules and policies have been altered or modified to suit other propagandic purposes. Since the implementation of federalized governing by British colonists here in the United States during the 17th, 18th, and 19th centuries, credit and debit are both still considered as debt, but instead of allowing yourself into it, you are literally born in it as of late November 1936. Many aspects of this concept of government has been scrutinized publicly on many different occasions. This portion of this topic is packed with so much information that I must give fully detailed untold truth surrounding it in a later documentary. But let me quickly note, transactions are daily made with the use of a credit card or a debit card, and most of us knows the difference between the two. A debit card takes away funds from your available balance immediately, with all liability falling upon you as the stakeholder, and a credit card takes away funds from your available balance intermediately, with no liability falling upon you as the debt holder. Listen closely. A stakeholder is any one person that relies on a business for profit or employment. Like, for example, anyone that makes an honest earning or wages and receives a check for it from the company they work for. While a debt holder is an owner of a bond, whereas any one person has borrowed funds and must pay it back, with interest in most cases, after a period of a year or more. Obviously, a debt holder can also be a stakeholder as well, given many different circumstances. Interesting enough, an investor can come out of nowhere and buy bonds from the issuer, who is the original entity that let you borrow the funds. Then immediately, that same investor now becomes a creditor of the issuer, seeking those same funds from the debt holder with even higher interest, depending on your borrowed amount, age, sex, national origin, religion, your address, and especially your race. Okay, now let's back up a little bit here and clear the air. The federal government established federal credit bureaus, or rather agency institutions, to control the implementation of credit reporting for businesses and consumers. In other words, credit bureaus collect and maintain individual credit information, not to exclude your credit history. Then they sell it for profit to lenders, creditors, and consumers in the form of a credit report. Now, I'm sure that many of you are aware of how credit reporting works, so I'll share the unorthodox information that you won't hear from these types of companies and their affiliates, like the ones that claim to fix your credit, for example. Although the Equal Credit Opportunity Act claims to prohibit creditors from including questions about race, sex, national origin, or religion on credit applications, racial disparities in granting credit cards or even setting credit limits does in fact exist, no matter how much banks continuously denies it. Multiple fair lending research studies proves that there is in fact a systematic form of industrialized racism prevalent in all financial markets, making those major banks and credit card issuers the main reason why many low-income American copper-colored borrowers are forced to seek loans from payday lenders and other high-interest, high-cost sources. According to a study by the Federal Reserve Bank of Boston, financial economist Ethan Cohen-Cole conducted the research study to find out where the bias in credit lending stimulated from. So, Cohen-Cole's research documents that people living in white neighborhoods are more likely to be approved for lines of credit and credit cards than those living in black neighborhoods. This derogative method used by these companies is called credit redlining. The term redlining describes the illegal practice of denying banking, housing, insurance, or other services in certain areas or communities based solely upon one's race. Just about 30 or so years ago, lenders were said to have drawn red lines on a map around areas targeted for differential treatment, hence the term redlining. Cohen-Cole stated that, quote, "I had data that is in principle the same data the credit card issuers have. I wanted to evaluate the same data they use to make their credit card decisions. When you fill out a credit card application, you don't fill out your race. However, they do know where you live, and they do know the racial makeup of where you live. By using that information, you can determine if the racial composition of the neighborhood is one of the criteria they're using." Then he went on to say, "The fact that credit is being differentiated by location is well known now. The question is whether or not they are also differentiating by racial composition of those neighborhoods. The answer is yes." Okay, now before I go any further, I want you to make note of some things that I mentioned earlier. I stated that an investor can come out of nowhere and buy bonds from the issuer. Then immediately, that same investor now becomes a creditor of the issuer. For example, if you did or did not owe a company money and they still pop up on your credit report, this will obviously bring your credit score down immediately. And all of the big three national credit bureaus, TransUnion, Equifax, and Experian, will have it publicly displayed for you as the consumer and all other companies to view it. And it can't be removed unless you either dispute it or pay off the balance remaining. But there is a hidden gem to this point that works in the consumer's favor. If a company has sold your alleged debt to a creditor, and your credit report reflects the creditor's company name and not the original company's name, then that merely means that a new contract was created on behalf of the original company. So not only is the original company seeking a particular amount, but now the creditor has added their cut of the amount on top of it. But this is what creditors and even companies that claim to fix your credit don't want you to know. As soon as the original company sells the debt or bond to the creditor, the original company gets paid up front and the original contract is voided. And the original company is now no longer obligated to uphold its portion of the contract. But wait a minute. That also means that the contract no longer exists. And that also means that you as the consumer are no longer obligated to pay whatever the amount was on the original contract. Why? Because technically, there is no contract. What does that mean for the consumer? He or she can easily have it removed now under particular stipulations on their own. Keep in mind that by way of the Fair Credit Reporting Act, all credit bureaus must make the necessary corrections to consumers' credit reports who can prove that those discrepancies or delinquencies are in error. If you would like to have assistance with getting this method done to raise your credit score, contact me by using the email listed in the description below, and I'll forward over the information with instructions. Now, let me get back to what I was saying. I also mentioned earlier that banks and credit lenders alike will deny using a customer's address to find out what race group the customer falls under, and then immediately base their credit lending decision with that information. Also, there's a reason why we see immigrants from the northern East Hemisphere of the world owning thousands of small to large sized businesses in America, and especially in the neighborhoods where people of color reside. Now that we know credit lenders will happily give lines of credit to people living in white neighborhoods, that also entails that white neighborhoods does not necessarily mean that it's referring only to who we may call as white people today. Why? Well, according to the federalized institution called the Census Bureau, a person having origins of any of the original peoples of Europe, the Middle East, and North Africa, their official racial group is white. I'm just here to make you think.